Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 17th edition of Market Outlook. So quite the week. Equity indices had smart rallies with the Dow and the S&P 500 making all-time new record highs, even in the midst of a terror attack, and then retreated on Friday based on just digestion of overall market action. And then news came out after the close about a coup in Turkey. So volatile times. Let's take a look at the markets and some of the internals and see what they're telling us and what our next steps might be. Well, first of all, a couple of good positive signs. Obviously, the follow through that we were looking for last week, the overall positive situation did materialize. You got the move up. That's looking pretty good. So overall, you can see on average somewhere around 1.5 to 2% or more on some of these equities indices, with the Russell picking up some lost ground. As you can see on a 52-week rolling basis, down 5%, certainly lagging. But this week we certainly picked up some lost ground. Now, the other thing to note in terms of the overall scenario is accumulation days. So you're sitting here with 4 accumulation days over the past several weeks in the diamonds, which are the Dow Industrials. So that's really positive. And overall, you can see that we're getting more accumulation and money starting to flow into the market. So basically confirming the overall price action, I rate this section of our market outlook a positive. Let's take a look at what's going on with the sectors, because that's quite telling as well. So a couple of things to know. One, what had been the leading sector was utilities. That's now dropping. So the risk on, risk off indicator inherent in looking at utilities versus the S&P flipped positive, right? So that's a risk on indicator. The other thing you can see is semiconductors, a more speculative group, actually picking up steam. So the 5-day action looking really good in the semis. You know, the last week overall really good, up 3%. Transportation gained as well. That's a positive. Financials still lagging, right? Although the 5-day or the weekly gain outpaced most of the market indices or matched them. So picking up a little bit on the down in sectors is a positive. The fact that utilities dropped in its leading place tells you some more risk on opportunities are emanating from the market. Also, let's take a look at just the overall amount of sectors that are up versus down. And as you can see right here in our table, something quite interesting that has definitely improved, and that it lends support to the market. I don't know what happened there. Okay. As you can see, right, this is the number of sectors up. All sectors are now positive 6-month rate of change, positive on all sectors. That is lending real strength to the market. That's looking really good. And as you can see, when the market sold off last year and into the beginning of this year, you can see the negative results here in terms of sectors that were up. You have the inverse scenario now, and in fact, you've got, from a sector strength standpoint, all sectors firing with positive returns. That's really a good thing for the market. Let's take a look at some market hotspots, overall areas of different asset classes, leading and lagging. So a couple things occurred this week, which was interesting. For one, even though gold miners, right, and XME, metal and mining, right, these are the leading areas of the market. leading asset classes. However, with gold selling off this week, you can see 5-day change down 2%, while the market was up 2%. So you're getting a little bit of cooling off on the gold miners, still in play, looking really strong. A couple of things to note as well. The biggest gainer was one of the lagging sectors in the market, which is biotech. So good sign, potentially some strength coming in to more speculative sectors. So the overall switch to more risk on assets is apparent here. As you can see, the biotech moving up along with gold and gold mining stocks selling off. Now, another thing to note here is on the inflationary side, you can see XME was on fire. So industrial demand, inflation type of scenario, definitely affecting XME, and it went inverse to gold. So remember, there's a big difference between XME, which is more industrial demand for metals, really positive, and again, picking up really strongly, while the alternative currency and flight to safety type of play, gold miners and gold itself, selling off. So again, depending what happens with the geopolitical situation in Turkey, which is certainly a key geopolitical point in the world, lots of trade. It's a sort of the gateway to the world, Turkey, and that is a very critical area. It'll definitely have a play on the global macroeconomic picture. So we have to keep an eye on that. But overall, you can see things definitely moving into some more speculative investments, and generally, that's the type you want to see as the market's hitting new highs. So let's take a look at some of the market internals here. First of all, the advanced decline and up-down volume, which really gives you a nice short-term read, sort of the health of the market. You can see we're a bit frothy here, bit frothy. You hit overbought levels, and with the sideways action and this bearish engulfing pattern, what this is indicating is you're running really rich. Now, we've done that before, especially take a look, around these areas here, and in essence, as we hit really overbought levels, we still continued to go further. However, before we did, we sort of went sideways for a couple days or a week or more. So what this is telling us here is, as the market is running a bit rich on up-down volume, the McClellan oscillator, which looks out about a month or so or more, also running rich and turning down a bit. But you really want to see all of these crossing their midpoints to really generate the signal. So I could see some backing and filling, maybe even a move back to the old level here of 212, 213, or even back to 210 on a digestion of this huge up move, along with that political uncertainty. And remember, we got that bearish engulfing pattern on Friday, which was we opened up at new all-time highs and then up closing beneath the wick of the prior day. Bearish engulfing pattern at all-time new highs on pretty good volume. You definitely want to take notice of that, but you definitely need the follow-through to confirm the negative signal. Otherwise, it just gets negated. So with this frothiness, wouldn't be surprised to see some sideways and backing and filling action, and I'd be definitely on the lookout and with an eye to the exit, considering the geopolitical environment and all the craziness going on, just with Brexit still in play, all these things, and we start getting below this midpoint here on the McClellan, I'm really going to take notice and be a lot more cautious. Let's take a look at a couple of other market internals and see what that's showing. So if we take a look at the composite, the big NASDAQ index, you can see similar scenario, right? Where are we? We're at pretty rich levels here. This is some of the richest levels we've seen in quite some time, right? In almost a year. So when you're running that rich and you've got that sideways action, you definitely want to be cautious here. You can definitely see a potential sell-off, certainly maybe a mild one, unless things really accelerate to the downside and we take out that midpoint level in the McClellan and the up-down volume ratio along with the advanced decline, which is this lower level here. So running a bit rich on the market internals, point of caution, and of course that sideways action over the last 2-3 days, along with that bearish engulfing pattern on the S&P, definitely short term is giving some pause here. Let's go to our next chart on market internals. New highs, new lows. The only thing you can say is it's looking really good, confirming what's happening in the sectors as well, right? You're right up here, at real strength here. The new high, new low ratio continues to stay at really strong levels, and you can see just nice confirmation across with the volume of new highs along with the ratio of new highs. They're confirming nicely. So nothing here to say, only a big positive. Let's take a look at what the NASDAQ is showing us on the same chart. And remember, this was the index that had been lagging, and new highs, new lows. Again, look what's happening here. You're at really strong levels. This is a positive. You want to see it staying above that 70 level. Again, this gives me another big positive. Let's take a look at our next chart. Okay, volatility. Well, not unexpected. As we're hitting new highs in the S&P, what's happening here, right? We're basically, well, because of the increased volatility, we're sitting in the midpoint of the volatility bands, of the bands, right, which is this and this, but basically pretty much close to all-time lows or trading around that in the VIX. When I say all-time, certainly over the last year. So that is positive. We're basically, trading under the 50-day and the 200-day moving average. That's all positive. We're going to have to really see an extreme here because of the blowout of Brexit. You're sort of getting a confused chart pattern because it blew out so much. So in order to get a really oversold reading in this, which would correspond to extreme frothiness and an overbought market, we would have to really see a strong rally in this particular move, and that would bring this down to a very low level here. So we're not quite at an extreme frothiness on the Bollinger Bands. On an absolute level, we're definitely trading pretty low. So overall sentiment, I would say, lends a positive to this market overall. Okay, let's take a look at the next chart. This is also volatility, short-term versus long-term. And again, remember I had mentioned that as you get in a really positive state in these levels here, it's a positive until you really start turning down and all these averages are turning down. So right now, we got really oversold. We had pointed that out and turned back up. We got our signal somewhere in here, or at worst case here, that we were, the extreme pessimism as a result of Brexit showed up in sentiment and then reversed. Meanwhile, we're still trading in a nice upwardly sloped situation and strong. And as you can see, even though we hit the same sort of levels, we still continue to drift higher along with the other indicators. So overall, I look at this as a positive as well. So besides the short-term pattern, to sum up, from the bearish engulfing on the S&P 500 to some frothiness on the internals, you can expect some backing and filling, and overall the trend to be intact, with the exception of something else materializes out of the coup in or the fallout from the potential coup in Turkey playing out in a negative way in the market. So with everything sort of on the table in a state of flux, from Brexit to the negative interest rate environment and the situation in Turkey, it's still very fluid, but markets do climb a wall of worry. So overall, technical picture looks good with that just short-term frothiness based on the market internals. So stay frosty, and again, stay flexible, because anything can happen here in the markets whatsoever. This is pure technically driven, and trying to predict with any certainty economic fundamentals or geopolitical fallout is really, really difficult. But chart reading still works. Speak to you next week. Thanks, and have a good week trading. Bye-bye.